The market opens with NVIDIA Corporation, NASDAQ, NVDA, trading at a live anchor of roughly $216.85 per share, resting comfortably inside its multi-trillion-dollar orbit. Across financial media, retail trading groups on Reddit, and mainstream financial cable channels, the daily consensus commentary remains hyper-fixated on the same superficial metrics: headline revenue prints, quarterly net margins, and generalized anxieties over whether hyperscaler capital expenditure cycles are beginning to decelerate. To the casual options trader staring at Robinhood charts or scrolling through stock market TikTok videos, NVIDIA is often casually dismissed as a fully saturated IA monopoly trade, a mature giant whose parabolic growth phase must inevitably hit a brick wall. Yet this public narrative misses the deeper structural reality of what is currently unfolding at the physics frontier of semiconductor engineering. The real constraint governing modern technology is no longer just how many transistors can be etched onto a silicon wafer, but how fast data can move across chips, server racks, and entire global data center clusters without succumbing to thermal throttling and optical interconnect bottlenecks. While retail investors debate daily price swings and short-term macroeconomic noise, institutional researchers and hardware architects are grappling with the harsh laws of thermodynamics. Copper traces are hitting absolute physical limits. Electrical resistance and signal degradation at high frequencies mean that scaling AI infrastructure requires a total paradigm shift toward co-packaged optics, liquid cooling fabrics, and complex multi-die system architectures. NVIDIA is no longer merely a chip design vendor selling graphics cards for gaming or early machine learning. It is quietly morphed into the sovereign architect of global AI factories, controlling an intricate, high-margin ecosystem where hardware, proprietary CUDA software, networking fabrics, and switch architectures are inextricably bound together. The market constantly misprices this dynamic by treating the company like a cyclical hardware manufacturer when it operates closer to a foundational infrastructure utility for the intelligence age. Beneath the calm veneer of NVIDIA's multi-trillion-dollar market capitalization lies a daily trading battleground defined by massive institutional volume, programmatic block trades, and systematic liquidity sweeps. Daily trading turnover runs in the tens of millions of shares, serving as a primary battleground where global macro funds, sovereign wealth portfolios, and quantitative trading desks reposition themselves around shifting interest rate expectations and geopolitical headlines. Whenever minor macroeconomic jitters emerge, such as hotter-than-expected inflation prints or shifting rhetoric from central banks regarding monetary policy, retail sentiment frequently overreacts, triggering sharp automated sell-offs. During these periodic pullbacks, financial media channels amplify fears of a cyclical semiconductor downturn, flooding social feeds with warnings that the artificial intelligence trade is overcrowded. However, a close examination of institutional 13F filings and Level 2 order book depth during these corrections reveals a vastly different picture. While retail investors get shaken out by short-term volatility, institutional heavyweights systematically accumulate shares, utilizing liquidity dips to build massive long-term positions. They understand that NVIDIA's structural order backlog and sticky enterprise software ecosystem insulate it from the traditional boom and bust cycles that plagued legacy hardware suppliers of the past. Before we move deeper into the structural mechanics of how this empire operates, let's pause and look at the broader landscape. How are you personally playing this volatility? Drop a comment below. Are you aggressively accumulating shares during every macro-driven market dip, or are you sitting on the sidelines waiting for a deeper technical correction? To truly understand NVIDIA's present-day dominance, one must look past its current valuation and revisit its foundational evolution. Founded in 1993 by Jensen Huang, Chris Malachowski, and Curtis Preem, the company initially set out to solve a seemingly narrow problem: accelerating 3D graphics for personal computer video games. For its first 2 decades, Wall Street framed NVIDIA through the lens of cyclical consumer discretionary spending, tying its fortunes directly to the PC gaming upgrade cycle, crypto mining hardware demand waves, and consumer electronics trends. However, a pivotal strategic bet made over 20 years ago changed everything. In 2006, the company introduced CUDA, a parallel computing platform and programming model that allowed developers to unlock the massive parallel processing power of GPUs for general-purpose scientific and mathematical computations, long before deep learning became a mainstream commercial reality. Today, NVIDIA's business model spans several high-growth operating segments, anchored primarily by its dominant data center division, alongside gaming, professional visualization, and automotive edge computing platforms. The outdated historical framing of NVIDIA as merely a component vendor misses the reality of its full-stack approach. The company does not just ship individual graphics processors, it delivers fully integrated rack-scale systems, networking switches, InfiniBand fabrics, and proprietary software libraries optimized for everything from large language model training to molecular drug discovery, robotics simulation, and autonomous vehicle navigation. By controlling both the physical silicon and the software stack that developers rely on to write machine learning algorithms, NVIDIA has created an impenetrable economic moat. Enterprises and cloud service providers can't easily switch to alternative hardware architectures because doing so would require rewriting millions of lines of optimized CUDA code, a switching cost that provides extraordinary pricing power and sustains operating margins that defy traditional semiconductor industry norms. Looking toward the multi-year horizon, NVIDIA's growth trajectory is shaped by a powerful confluence of technological catalysts, structural supply chain dependencies, and macroeconomic capital expenditure trends among the world's largest technology enterprises. The primary multi-year catalyst is the ongoing global transition from traditional CPU-based enterprise data centers to accelerated computing AI factories. As sovereign entities, national governments, and Fortune 500 corporations race to build localized sovereign AI infrastructure, demand for next-generation architecture remains robust. Furthermore, technological gatekeeper positioning in emerging fields like physical AI, humanoid robotics, and autonomous industrial automation ensures that NVIDIA's addressable market extends far beyond traditional cloud data centers. However, an objective analysis must also weigh the significant risks and bottlenecks that could challenge this trajectory. Geopolitical friction, particularly concerning semiconductor manufacturing supply chains and international trade restrictions involving advanced processing nodes, remains a persistent overhang. Additionally, the capital expenditure cycles of mega-cap tech spenders such as Microsoft, Alphabet, Meta, and Amazon are subject to their own internal return on investment pressures. If enterprise monetization of generative artificial intelligence applications experiences a prolonged lag relative to the billions being poured into infrastructure build-outs, a temporary moderation in cloud provider spending could introduce cyclical friction. Despite these near-term structural risks, the definitive takeaway for long-term investors is clear. Focusing exclusively on short-term price noise or quarterly margin fluctuations obscures the broader technological transformation currently underway. The world is transitioning to an era where intelligence is computed at scale, and NVIDIA sits squarely at the center of that structural shift as the defining infrastructure provider of the modern digital economy.